Good afternoon, everybody. I'd like to thank you all for taking the time to listen to what I've got to say this afternoon. None of this would be possible without the help of my partner, Chris Windward, and our sales assistant, Sean Gammon. So we thank them very much this afternoon for helping us out with this webinar. So let's get started. Today, we're going to touch on three topics: cattle inventory, capacity to utilization of production, and consumer demand and exports. The reason that these topics have become important to me today is because of the Elliott Wave count. And I'm going to use the feeder cattle index because it is an actual determination of what human beings are wanting to or willing to pay at the end of each and every day. So what I've looked at is when we got in under to the 20 lows, the 2020 lows, clearly that was the COVID, and it was a black swan event that nobody could have taken into consideration. What I recall, though, is that just prior to the outbreak of COVID, I had put out another webinar that said, why is swift trading become bullish cattle? Well, those events that I believed were going to be bullish still are to this day. The only difference is we had that black swan event that kind of curtailed a lot of the movement of the market earlier than what it has been. So we can clearly see from this chart that from the C wave low, we had a significant bear market from the 2014 timeframe to the 2020 low. Then we initially moved out of it into 21. We stagnated, and that first wave up, that first Elliott wave up, is a deciding factor between the bearish fundamentals that have been in play for years and the potential of some subsiding of those bearish fundamentals into a little bit more friendly. So now, instead of being one-sided where the bears have total control of the market, now both sides has a little bit, and then we see when we reach the level of price where we kind of stopped moving and we decided that we would consolidate through most of the year, that created the major wave two. So in my analysis of the Elliott Wave, I believe we have a major correction that actually began back in 2014 and 2015 when we began to overproduce our livestock and our packing capacity became very much smaller. So what we're dealing with more today now as we push forward, this is a daily chart of the feeder cattle index. You can still see the major wave one here, the subdivision of the major wave two, and now we believe we're already in major wave three. Of major wave three, we should have 5 subdivided waves, and I believe that we saw from April of 21 to July of 21 as the wave one. Then one of the most interesting aspects came about in which the cash market, in theory, pretty much stopped trading any higher or lower levels. And you can see that it was within a $10 range this entire time between that July high and the most recent low here in October. But the futures market, for whatever reason, continued to push dramatically higher, forming those enormously wide negative bases that we hope most people took advantage of from that August break in there. Once that took place, and once we begin to see how the underlying wave two correction was finalizing, I got the notion that once the index began to start trading higher, it was time for me to find some really good reasons to be bullish this market. So we're just now starting to see some of the turning points in the cattle market that may start to add a little bit of leverage towards the producer more so than the packer. So the first things that we noticed in that is we peaked the cow herd about 2017, just over 103 million head in the summer, and we ran 94.4 in those winter months all the way into 2020. In 2020, we began to increase the cow kill significantly, and then the production numbers by January of 21 began to sell off. So now the 20 through January of 21 to present, and we saw in the July where we continually have lowered the herd size. And in just a second, I'll show you some of the examples. We've killed more cows, we've placed more heifers. So going on from now, from 21 forward, if nothing different happens, if the drought remains, we're already on the backside of starting liquidation. Maybe it gets a little bit worse if the drought does not come about this spring, where we see some kind of moisture improvement in the Northwest. Maybe potentially the Southeast has a few more cattle that they are able to raise and offset some of that. But regardless, we've lost cows, we've lost cattle out there, and our herd size has diminished some. One of the drought impacts, though, in the spring, were we to get some kind of break in the drought, then I could see more heifers come back onto the farm instead of going off, and reduce that cow kill by just a little bit, and probably start to have lesser beef production. So we've already seen that between 20 and 21. 20 had a lot of cattle backed up, so we understand why those weights gained so much. And here we are in 21 with literally no backups, but what we're doing is we're placing more heifers. Heifers will slaughter at a lighter weight, and therefore we have less beef production. So to the packer now, where he has not had to worry about beef production because the cattle were so heavy and there was a greater slaughter number of steers than there are heifers in there now, then that beef production remained elevated for quite some time. Going forward with more heifers on feed, especially after the last quarter that we saw, we know we're going to have more heifers on feed probably into February, therefore producing less beef. Here's our yearly cow kill, and if you'll look, it is almost up to the peak we saw in 2011. 2011 and 2012 were huge drought years in Texas and Oklahoma, and to some extent Kansas. The cow kill was ramped up excessively there because they had no way to get rid of them. Now we've got the same situation here, and we see that here in 2021, it's ramped up. 20 ramped up a little bit. 21 has been ramped up. We have still seen anywhere from a 7 to 8% increase in cow kill month over month in the last probably 12 to 13 months. So we know that we have killed a lot of cows out there. We have probably strengthened the cow strength as far as putting new cows in there. But still, these old cows out there, there's still quite a bit of them that are dying. And if we think back to what these cows are, a lot of them were part of that expansion that we saw in the 14 and 15 time frame. Now those that were heifers back then, they're starting to get some age on them, may only have one or two more calves left in them. So something interesting about this cow kill is that that has produced a lot more beef as well. It has offset some of the steer meat on there. So if we do begin to see a lower cow kill, again, I think it suggests that we're going to see less beef production. In this case, less beef production is not what I'm thinking is the reason that all prices are going to soar so much. It's just that the packer is going to have to buy more cattle in order to supply that beef. So beef prices may or may not rise because of that shortage on there. Beef prices are still at a relatively high level, but that has little impact on the number of cattle that I need to meet whatever beef demand is there. So now we flip over to the packer and we talk a little bit about his capacity and utilization. So employment seems to be the biggest issue right now, as best as I can see. And here's a recent chart that we've got on unemployment. With it as high as what it is, and this is a twofold situation with the unemployment. Right now, the high unemployment is working on the packer's ability to process at a quick speed. If Jim doesn't show up for work, there's not Larry to take his place. So with the higher unemployment on there, this is going to potentially be a little bit better going forward as we see the trend in that is moving down. So we hope that although the employment situation is pretty dire right now, it has great aspects of improving in time. Our next one is the age of the packers. So when we look at the big four out there, and a lot of those plants are very antiquated, we see them having fires often now. We see them have electrical problems. They got to shut down to clean their coolers. There's just every kind of aspect that they can use to say, well, our machines aren't down, over and above the employment aspect. So we're starting to see more mom and pop operations. We've got ideas that there's 2 to 3 new packing plants already been funded and in the process of breaking ground to. So I believe that the major packers are going to have to do some modernization. They'll increase robotics, they will increase potentially employment to some extent, but all of those factors would go a long way in saying that if we're going to make these adjustments, we're going to have to need more cattle to kill, because what we know from times past and from 2010 back, we saw excessive packing capacity and fewer cattle. It was stated that the packer had to bring in 100% into his plant for it to be profitable. And after all of the cuts were sold, it tended to be the high and offal is what made them the profit at the very end. So processing was a dead break even. You sell the high and offal product, and now you become profitable. So as the tables turn, where recently we have gotten too many cattle for the packing capacity, I think that's starting to level off. The local packing facilities are anticipated to remain and stay vibrant and continue to grow. I know that there is one right now in Clarksville that's being built, Clarksville, Tennessee, that I don't know how many head that they'll do, but it is a great need. And what we are hearing throughout all of our association members and stuff is that consumers like that homegrown product. We see them shopping at the farmers market more, and we see them visiting more meat processors in the local area. I've talked to many cattlemen saying, I just have people calling me out of the blue and say, can I buy a cow? So I don't think this is going to go away anytime soon. So I believe that will do nothing but help, and any help that the packing facilities can have as far as increasing should be relatively friendly to the production side of the market, simply because that's what seems to be what our problem issues have been all this time, is too many cattle for the current packing capacity. So we got another issue with distribution. Distribution is gridlocked in multiple manners. Number of drivers available, number of trucks available. The one breaking point that I will say to this is generally the trucks designated for agricultural movement of some kind, be it grain hopper or a livestock hauler, those trucks pretty much stay where they are. That they don't tend to run into long haul trucking into areas that would somehow or another be restrictive to either government restrictions, COVID, or union protocols. So although the number of trucks and truck drivers could be an issue at some time, right now in the agricultural sector, I don't think it's that much of a problem. But these restrictions that we've already seen can cause significant problems going forward, and I think that they will. This could lead to greater separation between the majors and all the others, because we saw this week that Walmart and Sam's Club and Costco have now have a desire to own more warehouses. More warehouses is a control of my supply line. I can't wait for somebody else to unload that ship and send it to a warehouse so that my trucks can pick it up and go. We're going to vertically integrate further. And that's what I think that these industries are doing. We've already seen them in the meat market being vertically integrated. We believe that there are some feed yards that feed solely for some of these companies out there. So vertical integration is not only here to stay, but because of these issues and because of the fragility of our supply lines, it's going to increase. So don't think that once this is over with, everything's going to go back to normal. I really believe that the current administration will help to promote further vertical integration simply because they want fewer leaders out there. The fewer leaders there are, the easier it is to control anything. So that's what we're talking about, is controlling our supply lines. And I believe that vertical integration is one way that they're going to continue to do this. So we go into consumer demand and exports. Elevated unemployment. Again, we saw the chart there. I'll bring it right back up again. There it is. So in one retrospect, because so many people are employed right now, it's a little difficult to say that they're going gangbusters and buying a lot. So if we believe that unemployment will continue to decline, it would suggest that more workers out there are either having a better job, increasing in wages, or somehow or another being back into the workforce. Another factor is, again, with the current administration, I think the subsidies are going to continue. They're seeking a deal for this $3.5 trillion social agenda. child and dependent care credit expanded all the way through 21 and already into 22. And Pelosi's very confident that the Democrats will reach a deal to salvage the Biden agenda. This just means more money out there, in my opinion. You can't provide all of these social agendas without the money. So we know that they weren't able to get certain things passed to get it. Now we're asking billionaires to come in and just go ahead and pay your fair share or whatever it is that you risked out there. We want you to pay it back. So with the current administration for at least another 3 years, we believe that more subsidy and stimulus packages will be available, therefore keeping the money readily available to the consumer. Where it is my opinion and my opinion only, I look at it as a circle that cannot be broken. The current administration is looking at the inflation and saying these poor people out here don't have enough money. So let's do? Let's just give them more money. So the more money in the stimulus packages and subsidies that we have, I think that helps beat. Clearly, it has not hurt it at all. So here's our inflation levels right here. And we see back in 1990, it reached 6.4, and that's the level that we're headed for right now. We're right at about 6 on that. So we've only been there a couple of times in 1975 and 1980, but with oil prices here, and we look back at the 2007 and 8 area when oil was at $150 a barrel. Oil is almost half that price now at $80 a barrel, but all other factors of inflation are significantly higher as well. So that looks like a pretty steady trend. It looks like a breakout from the 2010 area because we consolidated quite a bit from 2013 all the way to the 2020 low. So now we're breaking out to the upside with all of the money going out, with all the money that is available right now, and all of the money that is in the stock market right now, because there's no other place to put your money. That money right there may come out and be used for commodities at some point in time. That won't make inflation go down. That'll make inflation skyrocket. And that's one reason why I'm so adamant to be trying to be forward out looking so I don't get hamstrung by some of these little smaller moves that we're seeing right now. So here's our export numbers. I listen to Ed Serwin. I think Ed puts out a very good product, and Ed has stated that he believes that exports are going to continue. We see examples like this where our exports, as in this year, if you look back, it wasn't in 2018 where our exports exceeded our imports. 19 it didn't, 20 it didn't, but look, now we've got it in 21, we have our exports exceeding our imports, making us meet deficit just a little bit. It's highly unlikely that we will buy tons of beef from Brazil. It's highly unlikely that we will do much business with them. I know that we're open to do business with them, but they've got some health issues, and China has made that very apparent by stopping all of the imports from Brazil into them. They've also had a little feather ruffling with Australia, so they have halted another meat processor shipping meat in there. Although we know that we don't send a tremendous amount of beef to China, it has been increasing, and our exports have not faltered by hardly anything at all. So our export market is anticipated to stay relatively good. Our dollar has not moved much percentage-wise in order to make the very little price change that we've had in cattle or any of the grains so in the last 5 or 6 months to make a big difference. But we know that it could in the future if we do have more government intervention. The Federal Reserve comes in and does something with interest rates. They do begin to taper the market. Those factors will have an impact on the US dollar index. If it does begin to rise, if they make those feats that they are trying to accomplish, if they make the dollar rise, it's going to be tough, but it's probably not going to be instantaneous. Again, we have lots of money out there, and right now we've got lots of shortages of supplies. So to kind of wrap this up and looking at one of the biggest factors that I always think back on is, how did I not see that 2-3 year long bull market or bear market in the commodity that I'm looking at, and how did I miss that? And I can tell you honestly that most of it is because we were so focused on today and that next expiring contract month that we're in, we tend to lose focus on the long-term objectives of what these commodities are doing. So with the advent of the fertilizer crisis, it's really struck home about what it's going to be like over the next 2 years. So I've included a chart of the July of 23 corn. Note that it set another new contract high today, has already broken above all of the consolidation that the spot months are still dealing with right now. This kind of leads me to believe that if we go all the way out that we see for the historical high of corn and the July of 23 time frame, anywhere in between there is very possible for corn to go to. It'll take a month of Sundays to get there, but the relationship right now is we have ample plenty corn at 15 billion bushels. We get into March and April, and for whatever reason, primarily I would dare to say that the fertilizer is the biggest issue, and they do plant less corn. They come in at 88, 89 million acres of corn and 96, 97 million acres of beans. Those are just, guesses out there, but if they come in like that, that makes the July of 23 corn even that much more significant because you've got lesser of it. Now, at the end of the end of December of 22, at harvest, you'll probably have plenty. Even if it's a short acreage crop, it's a short crop, you still got an abundant, but where it's really going to get short is July 23. The best example I know of today is Minneapolis spring wheat. We lost the Minneapolis spring wheat crop in the summer of this year. The summer of next year, you won't have hardly any at all. If you don't have a crop next year, you can only imagine what the 23 crop price could possibly be. So 2 factors, you got all the money in the world out there to buy it, and the government is continuing to shovel it out there because the equity markets keeps going up. And if the equity market's going up, I have more money at the end of the month than I spent, and I have to do something with it. And since nobody's going to pay me to store it out there in a savings account, I have to put it into speculation. That's what the intent of this is. We don't want, the reason I've got 0 rates out there, I don't want you to save it. I want you to get out there and spend it. That's the premise behind that. So as we go forward and look, we're going to summarize this to the Elliott Wave structure is what set me going forward on this to begin with. I kind of had ideas back in early of 20. They all got bombarded by the COVID. Nobody knew what to do, myself included, and I feel very fortunate I'm still alive here today. The inventory shrinking with potential for expansion to reduce heifer placement this spring. That's a friendly atmosphere right there from the production side of it. Packing capacity nearing adequate levels to process inventory going forward with potential improvements in employment and modernization. We've already seen the worst of the worst. We've seen the black swan of the COVID. We've seen the fire, the Lenny County fire. A couple of weeks ago, we had an electrical fire in one of the plants. All these small little nicks and dings, we're used to those now. We really have to come up with another black swan event, I think, in order to turn the tide back negative towards the cattle market, not the beef market, the cattle market. So packing capacity, if it improves a little bit, we get a little bit more improved unemployment or improved employment. Higher wages are already being touted out there, and we believe solely that the government subsidies are not going to end anytime soon. So the money aspect of it there should be there for quite a while. Exports are anticipated to continue to rise for U.S. beef due to quality control and taste preference when it's compared to Brazilian and Australian grass-fed beefs. So that taste alone is probably the biggest deal that the U.S. beef has over anything else. It's clearly not price, but we've seen $100 be take off the box price, so that's 33% decline. I think what you'll see is the reason we're starting to kill a few more cattle now is I want that beef in the grocery store the day after Thanksgiving. The Black Friday sales, the whatever, getting ready for Christmas time. I think that we have seen a very, very good movement of the rib in this time frame, and today is the day they're starting to prepare for that. So just kind of know that that's coming up, and I think you'll see more and more cattle slaughtered because of that. The funny thing that I find most interesting right now is seeing the feeder market down a little bit, almost to an even basis, $2 negative basis. And when it was when it was $11 and $12 wide, you were seeing futures traders out there jumping on it every single morning like there was never going to be another feeder out there. Now we've converged the basis to near even. We've got a really big change in the cattle inventory, and they seem to be very reluctant to do it. So what that tells me is we've seen some increase in open interest, and that's probably the guys really in the industry. Maybe those that kind of see similar things, aspects that I do. But what we're really not seeing is the commodity funds yet jump in. So my aspect of it is I want to get rid of anything that's going to hamper my upside potential. I do not want to neglect marketing when those opportunities arise. And I think I'll get some better marketing opportunities than what we've got right now. And now that we believe that the fundamentals have changed and are going to push the market a little bit more friendlier, we also swap our hedging ideas to more so help the cattle feeder than what we have been adamant of helping the backgrounder. The backgrounder has had huge premiums to work with that are no longer available to him. The cattle feeder has had very egregious premiums that he's had to work with. He didn't want to pay $12, $13 premium out in the future for cattle that were trading $12, $13 cheaper at present. So this is a swap as well to help the cattle feeder now. The cattle feeder, being somewhat vertically integrated, as best we understand, is not going to have many more choices going forward. If margins start to turn bad on him, those contractual agreements will keep him buying feeder cattle and keep him buying corn in the worst of conditions. So that's a double-edged sword too. So when we look at cattle feeders, regardless of whether you're within vertical integration or out of it, you're going to have that initial product of the feeder cattle. And we believe they were going to go in shorter supply and that the kills ratio for the packer will increase because of the heifer, the lower heifer weights, the slaughter weights. He's going to have more cattle to produce the same amount of beef out there. So that's all I've really got. I wanted to say this one thing that I've only cleared through a couple of different clearing firms. When I was with J.C. Bradford and Company, we cleared through Revco. We moved to Rosenthal Collins Group in 2000 and remained there until 18 or 19. And then we've recently moved to ADMIS, Archer Daniel Midland Investor Services. And I will have to say that being an IB with this clearing firm has made it so much easier for us just simply because of the back office. Although they have great analysis and things like that for us, to our clients, we have noticed that our clients have been able to read their statements, have access to their statements 24 hours, and also have it to their trading account. And although it may not be live as far as that goes, it is within just a few minutes of you put a trade on, you're able to see that trade in your account. So just a little bit of office work here to tell you that we are very, very pleased with ADMIS's background to us and our back office support for us. So if you think that for some reason, regardless whether you like my analysis or not on there, if you're not happy with the brokerage firm you're at, and it may not be your broker, it could be just the firm itself, take a minute and call us and let's see if we can't do something a little bit different. So I'm going to open this up to questions now. And any question, please type it in, and we'll try to get every one of those answered. And if not, never hesitate to give us a ring here at the office. Are we headed for another 2014-15 price episode? If so, when? Probably not. I don't know that feeder cattle prices are just going to blow straight up because we're not at the lower inventory as what we were in that 12-13 time frame. The liquidation at that time was very similar to what Australia just went through. It was liquidation only. Nobody had anything to carry any cattle with whatsoever, so they just liquidated them. As best I understand, some of these cattle in the drought areas were able to move a little bit south, a little bit east, and get them out of that and maybe bring those herds back onto the ranch at some point in time. So as far as price goes, no, I don't think you'll see it go up like that. We don't really have the basis to pull it up there just yet. We don't have the futures running leaps and bounds that might help draw that index up. And I'm not real sure how quickly you're going to be able to get the commodity fund traders to heal from the shellacking that they took over the August time frame. That was a real fundamental issue. Traders boosted the futures market up. The cash wasn't there. It was a fundamental convergence of basis, and that's it. There was just nothing else to it but that. And so, and because this is real commodity markets and they're deliverable, I think it's going to take them a little bit more to get anxious to want to position themselves in such a vulnerable shape again. So where do you see the U.S. dollar going? I'm very negative, the U.S. dollar, because of all the subsidies in this current administration's agenda of socialism. That I think you have to have more money put out there in order to make subjects out of people. You got to pay them to be subjects. So I think that you're going to see more of that. I do not think that you're going to be able to get enough money out of the billionaires to even make a dent in this. So therefore, we get another stimulus package, and that just floods the liquidity into the market, and we cheapen the dollar again. How long will that take? I don't know. The tapering aspects and the raising of interest rates are becoming very slow. And although the Fed has stated, we're going to do this, we're going to do it, they've given us very wide timelines between mid-2022 and maybe even as soon as November the 2nd, this next upcoming FOMC meeting. So I got one here. If we see a huge run up in fed cattle, we'll have to go up and feeders down. Run up in feed. Cattle will have to go up and feeders down. Not necessarily. Remember, there's plenty of money for both right now. And the vertical integration makes for I'm really sorry that your margins are not as good as what they used to be, but I need you to meet that contract. So initially, I think both can go up. And the reason I say that, we've already seen that. We saw in the same time frame, feeder cattle prices rise, and we saw corn prices rise. They both stagnated through the summer, and now we're moving back up again already in our corn price. And just the last 2 days, we've been down in the feeders, and we really hadn't broken any new lows or done anything, just kind of wallowing down here, because I don't think you've convinced many people that this market's ready to go up yet. It took a long time to convince people while corn was wallowing down, that it was going to go up. Now that it's breaking out to the upside, we see more and more participation to it. So again, I can always be early. I primarily am early in most of my aspects of life, but in this particular case, I may not be too awful early, and we could see both those go up at the same time. What is your price target for the fifth wave? Right now, I'm not in the fifth wave. I'm just in wave 3. Wave 3 should be 1.618 times greater than what the wave 1 level is. You're talking about $195 to $200, and I think that's very possible, but not anytime soon. More likely than not, if we go back and we look at the July of 23 corn contract, and we say, wow, in about a year and a half, that's going to look really good. The same thing for feeder cattle. The one difference in feeder cattle, if things do rise, August is already at 172. If the index goes from 154 where it is today to 172, August has never moved. And you know what? We're still trading 172 feeder cattle. So we have to be careful about that. The futures market is going to now probably beat us to the punch going forward, coming on the board at premiums, making it a little bit more difficult for us to expand that out a little bit more. So right now, probably, I think if we got back up to 170 to maybe 175 on the index, that would be a $20 rally, $15 to $20. That would not be unheard of, and that's probably about what I'm looking for. Look at the one above it. So talk about choice versus select spread and how it affects cash price or futures price. 78% of all our cattle now grade choice, very little of it grade select. The product that grades select, although still, you know, sizable in it, tends to go to processed meats, processed foods, or other lower shelf cases in the meat cases. So I think that the choice market, it's really moving. It's not going to change anything. And I don't think that spread between choice and select has that much dependency. I couldn't look at a choice select spread and go, I'm going to buy cattle today because of that. So in my analysis, it doesn't hold a lot of preemptive ability to outguess where the next move's going to come from. So I don't see any more questions there. Again, I want to thank you very much for taking the time to do it. Never hesitate to give me a ring here at the office. I know sometimes it's kind of tough to want to call and introduce yourself, but we're pretty friendly guys here, and we really do want your business, and we want to try to help you do the best job that we can do. So y'all have a great afternoon. Again, thank you very much.